It's a very great pleasure and privilege to introduce Mario Draghi as our luncheon speaker. I think no one at this point in time is any more directly engaged in the efforts between the two sides of the Atlantic and, of course, the rest of the world to come together and forge new policies in a critical area. Here, of course, the area of reform of financial regulation and the global financial system. The obvious causes of the crisis in that area triggered a need for both new rules and new institutions to develop and govern those rules. And Mario Draghi has been the person chosen by the global community to lead that effort. Mario, in fact, has at least two full-time jobs. He's, of course, still governor of the Bank of Italy, but also since 2006, when he became chairman of the Financial Stability Forum, that in turn changed into the Financial Stability Board a year and a half ago. He's also a member of the Governing and General Councils of the European Central Bank. That's a third hat. He's a member of the board of the BIS. That's a fourth hat. So he has a lot on his plate, and I deeply appreciate, Mario, you're taking the time to join us. I had lunch with Secretary Geithner about a month ago, and it was just before he was about to chair the first meeting of the Systemic Risk Council that was created by the Dodd-Frank legislation to take an overview of the U.S. financial system going forward, try to anticipate global financial crises. So, of course, I said, well, shouldn't we have a similar global Systemic Risk Council? And Secretary Geithner said, well, I think that's what Mario Draghi's doing. That's certainly what we hope and intend for him to be doing. So he's the guy watching over the entire system, and we look forward to hearing from him today. I also found out, as we were talking before, that he's a fellow basketball player. That makes me particularly pleased to welcome him to our podium. Mario, thank you for coming. We look forward to your remarks and to hearing how you're coming and leading the global financial reform process. Thank you very much.
Well, thank you, Fred, for your very kind words. But also thanks for having me here. The issues on this conference are highly topical and full of challenges, as you just hinted at. Just as it's the case for tackling the problem of global climate change, another important topic on your agenda today, achieving a more stable and resilient global financial system requires coordinated action at global level. The US and Europe have strong joint interests in this and are critical to the progress. But so are the growing weight of countries beyond these continents, and they have come to play an increasingly important role in shaping global outcomes. What I plan to do today is first review what we have achieved in terms of financial reforms. And then I will turn to the important challenges that lie ahead. Now I will conclude with thoughts on international policy coordination and just 2 words on the role of the FSB. We've come a long way towards strengthening the financial system since this crisis began, reflecting an unprecedented amount of international coordination in achieving consistent reforms. While issues remain to be resolved in Europe, in the US and elsewhere, we are collectively fundamentally reshaping the framework for the systemic financial oversight. Let me note some examples. First, top-down, system-wide oversight arrangements are being put in place at national, regional, and international levels. These arrangements are designed to deliver more encompassing surveillance, with broadened macroprudential perspectives and better mechanisms for triggering action on identified risks, Examples of these arrangements are the European Systemic Risk Board, the US Financial Services Oversight Council, and the IMF SB early warning exercise, and the establishment of the FSB itself. Second, major jurisdictions have overhauled their regulatory and supervisory structures to strengthen responsiveness to risks, improve coordination, and close gaps. The FSB is in many ways the international manifestation of these domestic efforts. Third, the regulatory perimeter is being expanded. Major jurisdictions have finalized legislation, or will shortly finalize legislation, as it is in the case of the EU, that establishes regulation and oversight over the OTC derivatives markets, hedge funds, credit rating agencies. In each of these areas, principles for what regulation should achieve have been internationally agreed, and implementing regulation is being closely coordinated. Fourth, we put in place cross-border oversight and contingency planning for the largest and most complex financial institutions, each of which now have functioning core supervisory colleges and crisis management groups. At the level of the essential regulatory policies to buttress financial stability, let me recall that with Basel III, we have fundamentally revised global bank capital framework. We now have, it seems obvious, but we now have a globally agreed definition of capital. We have much improved risk coverage. We will have higher quality capital, a counter-cyclical buffer, and a constraint on the build-up of banking sector leverage. Second, as part of Basel III, we will for the first time have a global liquidity standards for banks that will promote higher liquidity buffers and constrain the maturity mismatching that created the conditions for the crisis. Third, we are making progress in developing a policy framework and tools to roll back the moral hazard risks posed by institutions that are too big to fail. I will say more on this in a moment. Fourth, we have eliminated the perverse incentives that pervaded securitization, including the scope for leverage to develop in opaque off-balance sheet vehicles through changes to accounting standards and regulatory and prudential rules. Basel II had these incentives have been eliminated now. Fifth, we are establishing central clearing of standardized contracts in the OTC derivatives markets, and an OTC global trade repository is now in operation. Fifth, we have developed a series of supervisory tools to raise standards of governance, risk management, and capital conservation at financial institutions. In this context, let me note that we are making good progress with accounting standard setters towards expected loss provisioning regime for credit losses, which will dampen procyclicality and align accounting and prudential objectives in this key area. And we also have principles and standards that have been issued to better align compensation systems with prudent risk-taking. The standards give supervisors powers to restrain compensation structures and the level of payout to conserve capital in the firm. As we move to raise capital levels, we will further encourage supervisors to use these powers. I have been selective in my enumeration, but the point I am trying to leave with you is that we should not underestimate what we have accomplished. Each of the above areas are difficult in their own right, but let me tell you, the financial services industry today is a different world from what it was 2.5 years ago. That we have been able to progress global policy development and implementation on such a broad front while fighting a very serious financial crisis is something that has never happened before. So, the direction in which we are moving internationally is encouraging, but important issues remain, and its political resolve that will determine whether we accomplish the credible and robust reforms, yet preserve the enormous advantages of an internationally integrated financial system. Let me say 2 words on addressing the too big to fail problem. This is perhaps the most challenging remaining legacy of the crisis. Basel III will greatly strengthen banking system resilience, but it doesn't address this problem. The FSB has assessed a broad range of policy options in this area and will present its recommendations to the G20 summit in November. It's important to recognize that SIFI, systemically important financial institutions, vary widely in structures and activities, and that the nature and degree of the risks they pose also differ. Some are large, complex, highly integrated global financial institutions with activities spanning a range of sectors. Others may have a global customer base but are simpler commercial banking operators. Yet a third category is entities that are large at a domestic or regional level, but nonetheless globally interconnected through wholesale funding markets. I think you have a paper in this conference that's, I don't know whether it's going to be presented in the afternoon or it was presented in the morning by Maurice Colson, which deals extensively and variably with these cross-country differences among SIFIs. Whatever their nature, SIFIs have 2 things in common. That their uncontrolled failure would cause significant systemic disruption, and that we, as authorities, cannot, at present, resolve them in an orderly fashion without the use of public funds. The framework we have agreed to address SIFIs is therefore based on 4 necessary pillars. First, we must radically improve our capacity to resolve SIFIs without disruptions to the financial system and without taxpayer support. Effective resolution regimes must advance the goals of both financial stability and market discipline. This means they need to be able to impose losses, first on shareholders, but also on creditors, while ensuring continuity of essential financial functions. Great effort has been undertaken in this country in this direction, but also in Germany and in Switzerland and in the UK. I think we've reached a point now when we can actually draft a sort of benchmark, a standard resolution regime that then all countries, all jurisdictions can use as a benchmark to draft their own domestic resolution regime, and we will assess whether the differences are actually internationally consistent. In addition, we need to acquire additional resolution tools. The bail-in debt of debt holders holds significant attractions both from the perspective of correcting creditor incentives and protecting taxpayers. But the legal issues associated with bail-in and in a cross-border context are certainly non-trivial. Moreover, to be effective backstops in dealing with global firms, national resolution regimes need to converge towards common standards. And these need to be supplemented by cross-border cooperation arrangements underpinned by national law that provides both mandate and capacity for resolution authorities to cooperate. Legislative changes will be needed in many countries to enable this. Lastly, living wills will be mandatory for major firms. These will include assessments of firm resolvability. Supervisors will have the power to require changes to a firm's structure to improve its resolvability. Second, the loss absorption capacity of systemic firms should reflect their role in the global financial system and their potential contribution to systemic risk. Even with the best possible resolution tools, the failure of a major global firm would cause significant damage. This reinforces the importance of strengthening the resilience of major global firms. Higher loss absorption capacity for SIFIs than the minimum agreed Basel III standards especially for the largest globally operating CFIs, are at the core of our recommendations. The way we view this process is a universal commitment to put in place what is needed to increase the loss absorbency capacity of the CFIs, a universal commitment by all the jurisdictions that have CFIs. But then how this commitment is going to be satisfied, whether through capital surcharges or contingent capital or bail-inable assets, will be a matter that has to be decided. Because, as I said before, CFIs are not the same everywhere. They have different histories, they have different institutions, they have different business models. Therefore, it's essential that we have in place a credible process of peer review that will challenge the policy choices made within each jurisdiction and let me see. And to ensure that measures applied on a country-by-country and CFI-by-CFI basis are consistent and mutually supportive. The third area relates to strengthening oversight and supervision. Senior line supervisors have drawn a frank assessment of weakness leading up to the crisis. These weaknesses were not present in equal amounts everywhere, and there is scope for improvement all around. Our recommendations in this area have been developed with the IMF. One set is focused on the mandates, independence, and resourcing of supervisors. Another is on improved methods and practices to proactively identify and address risks. Fourth, we will be setting out higher robustness standards for core financial infrastructure. These infrastructures, including for central counterparties, are themselves sources of systemic risk were they to malfunction or fail. This is a complex project which will unfold over a number of years. It will need to be consistently implemented in all major countries to maintain a level playing field. The already established FSB framework of country and thematic peer reviewing process will address improved resolution frameworks and more intensive supervision. In addition, for CFIs, with the potential to create damages at global level, we will establish a mutual policy review process that will challenge the national policies towards that each jurisdiction undertakes vis-à-vis the CFIs, their CFIs. Ahead of us, other issues still require attention. So far, most of our attention has been on strengthening the resilience of the banking system, and rightly so. Yet, the shadow banking system remains a large part of our financial systems, less regulated, but nonetheless significant in the credit intermediation and maturity transformation, and subject to runs in damaging ways. We need to make frameworks for macroprudential policies and system-wide oversight operational. We will be sharing approaches for surveillance, powers to obtain information, and modalities for action on identified risks. The FSB will coordinate approaches where an international regulatory response is needed. We will be working with the BIS and the IMF to build principles for effective macroprudential policies. Lastly, the FSB is developing arrangements to broaden the involvement of non-members in its work at early stages of policy development. We will be setting up regional arms of the FSB. Each regional group will be co-chaired by an FSB member and a regional non-member who will attend the plenary meetings. So let me conclude. Three things have been important in making the progress we have made on reforms. First, I think it was the sheer seriousness of the crisis and the recognition that in a globally integrated system, we all sit in the same boat. Second, the readiness in the official community to agree objectives and timelines for substantial reform, including through the G20 process. And third, the establishment of mechanisms such as the FSB to hasten the policy development needed to meet these objectives. I'm quite confident that with these we will be able to achieve globally consistent rules that will lastingly increase the resilience of the financial system and the real economy and deliver the level playing field that a global system needs. Thank you. Yes, sure.
Okay, Mario has graciously agreed to answer some questions, take alternative views, and challenges as to what he said. So, the floor is open. Please identify yourself and fire away. Jean.
Thank you. You mentioned the macro-prudential supervision and the creation of the institution in the US and the fact that it's soon to be created in the EU. So it's a major achievement in institutional terms. What is not entirely clear to me is what it means in policy terms. What is exactly the role it has in the whole policy framework? What are the instruments? How advanced is the thinking in this respect?
Should I collect? Oh, okay, I can answer. Yeah, all right. Well, first of all, the concepts differ across jurisdictions in terms of these sort of global, top-down oversight mechanisms. In the case of Europe, we see that the outcome was a compromise between the desire and the need to have a central mechanism of supervision with powers to intervene directly on specific institutions, and the national supervisors who wanted to retain control. And I think right is on both sides, because clearly the national supervisors have way more information than can be held by any central mechanism, at least for a certain number of years. So I think the final proposal by the Larosière group, I would say, truly reflects this compromise. One could argue that a little shy on the actual powers that this new mechanism will have, being they limited to recommendations that, that as a rule will not be public. I think that is sort of, I don't know whether I'm capturing exactly this, but I think but I think, these things develop when people see that they work. So I have a lot of faith, I have a lot of faith in the actual doing things, realizing that they work, and then you have progress, and then you see that national supervisors gradually will accept more and more intervention from this central mechanism if they realize they have something, it actually can do things they cannot do, like coordinating macroprudential policy as they would not be able to do it right now. So I have more faith in this sort of process rather than in clear rules which imply an overall of powers and national mechanisms and bureaucratic changes that it's bound to take anyway a long time.
Anil?
Anil Kashyap, University of Chicago. Hi.
Hi.
You talked about peer reviews for SIFIs, which is interesting. What's your view on peer reviews of national decisions? So let me take an example. National decisions. So I know of no economist that thinks it's reasonable for a money market fund to have a fixed net asset value. Yet there are strong political forces in the United States that make me think that the Systemic Risk Council in the U.S. will never take that on, or at least not take it on in any meaningful way. Is there any scope for the FSB to be the adult in the room and just say this is ridiculous and put pressure on a decision like that, which I think is plausibly systemic, but not exactly in the framework you've discussed?
The FSB will certainly express views on national arrangements. But the peer review process that I've described goes a little further than that. And it's intimately linked with the objective of maintaining a level playing field. In other words, we have, around this table in the FSB, maybe I say a word on how it works really. You have all the countries, now it's been enlarged to 23 countries sitting around that table. And then you have the standard setters, the Basel Committee, the AIIS, the SEC, not the SEC, it's national. Each country has three people. One is the SEC, to use your categories. Then you have the central bank, and then you have the finance ministry, or the treasury ministry, or treasury department. So the idea there is to have the regulators, but also governments. And the second idea there that was at the origin of this concept, which goes back to the end of the 90s, is to make sure that the people who sit around that table are also the very same people who are going to implement what they have discussed. So they feel fully responsible. Or when you need legislative change rather than simple change in regulations, these people feel they are responsible for drafting draft legislation that then will be examined by the legislative powers. So that's how it works. So the peer review there is slightly, as I was saying, it's a little further than simply expressing views. When you have a change in regulation, you want to make sure that if you do something more in your own jurisdiction, everybody else is going to do the same. And so that's the sort of peer review. I would call it more peer pressure, because the review as such, the surveillance, the checking that things have been put in place, it's something that the FSB does through the dialogue, but institutionally is a task that belongs to the IMF. So that's how it works. I heard that some people think that these discussions amongst peers lead to peers protection rather than peers pressure. But as I've explained, there is no incentive at all to protect your peer in this around that table. All the incentive is in maintaining, first of all, in drafting regulation that makes sense, and second, maintaining a level playing field.
If there's no other question from the floor, let me just ask one myself, Mario.
Thank you.
You've mentioned along the way the need to compromise, pull together some conflicting views. What about going forward? This is sensitive, so obviously understand you're having difficulty commenting, perhaps. But are there still significant differences within the FSB on appropriate capital requirements, resolution authorities, the issues that had allegedly been the source of a lot of disagreement, particularly across the Atlantic, between some European and U.S. authorities? Do you feel those have been satisfactorily resolved, or is it a battle that will be fought again another day?
Well, as far as Basel III is concerned, I'm confident that the recommendations and the drafting of the Basel III, which has been endorsed at several stages already by the governors, head supervision, it's going to be presented at the next summit of the finance ministers and governors in Seoul, and will be ultimately endorsed by the leaders. I think my sense is that this is done, and I have no reason to think otherwise. Then, past that, you have some areas, many areas in fact, where either we all do the same, or frankly, it wouldn't mean much. Let me give you an example. The OTC derivatives, the centralization process of all the standardizable derivatives trading into CCPs, all regulated exchanges. And together with this, the mandatory channeling of all information about all derivatives contracts into trade repositories, so that this huge amount of information would be finally, eventually available to the authorities for policy making. These objectives are either pursued by everybody, or it's exactly the area where you have instantaneous regulatory arbitrage that would nullify all the efforts. And so far, on this area at least, I'm actually quite confident that everybody wants to have the same thing. They want to see through. One of the problems of this crisis is that we had a huge area, which was a black hole. You remember these numbers in the aftermath of Lehman, these numbers about the volume of derivatives contracts in existence. They were changing every day, gross and net. And for a long time, I think, for at least for a few months, people really didn't know exactly what they were talking about. So this is one area. Another area is the credit rating agencies. You have many dimensions to this, but again, it's a point that unless either we agree about how to regulate and treat and legislate about CRAs, or frankly, again, one CRA would simply establish itself somewhere else. On resolution regimes, that's an area. Let's not forget that resolution regimes are really the byproducts of a much broader set of legislation, which is the bankruptcy legislation. And that is a very complex piece of legislation that differs across countries. I mean, in Europe, we have, I guess, 27 different bankruptcy laws within the Union. So it's very likely that the national resolution regimes will differ as far as this or that detail. And there, the task of the FSB will be to make sure that if they differ, their differences don't hamper an effective cross-border resolution when it happens. Let me give you an example of things that would hamper this. If you have automatic ring-fencing of assets in one country, whereby these assets would be frozen in that country, and the bank, which is established in a different country, could not use these assets as a collateral to fund itself in case of need, perhaps with the central bank. And so you could have a failure there, even though the bank might be in principle perfectly solvent. So we've seen this on and on and on with the Lehman, but also in other cases. This is what we really want to overcome. Then you have another area, as I think I hinted at that before. You want to have for the SIFIs, you want to have a higher loss absorbency capacity than the one given by the minimum Basel III standards. Now, in some countries, this could be achieved in the most straightforward and simple way, namely higher capital. And when I say higher capital, I mean higher ordinary capital, higher common equity, good quality capital. In other countries, this could be either more difficult because of the structure of shareholding, or because the business models of the SIFIs are different. They are not so much trading based, but more on traditional commercial lending. In which case, they may want to use instruments that are different, like contingent capital, namely bonds that become capital at some point, or bail-inable, as I said before. Let me add immediately that these instruments are not fully developed in their design or even in their legal structure, really. There's a lot to think about these instruments. Contingent capital has been studied and discussed now for several years in different forms, but to say that we now have a usable concept of contingent capital would be to say too much. So I'm saying that we're trying to, basically the bottom line of what I'm saying is that we're trying to have an area as broad as we can of basically fully coordinated, almost exactly the same thing. But there are things that are naturally different. They should be kept different.
Okay. Floor is open. Yes, Ted. Oh, I'm sorry. Didn't see what over here.
Mario, I would like to ask you a question on the too big to fail issue and on CFIs, because I think that there are two dimensions of the issues. The technical one, which you raised, and I think that you have very good avenues, but there is a political dimension. And when the crisis arrives, and when you have a CFI which is collapsing, then you cannot avoid to have some kind of political interference. That has been always the case, and it will be always the case. You have a lot of examples. So, how do you introduce in your mechanism the fact that you will have, at one point or another, political interference with the problem of different jurisdictions and so on, which is, in my point, one of the most difficult issues you have to face?
No, I think you're absolutely right. But our task really is to, in this sense, is to prepare draft legislation or regulation, which by itself eliminates many of the inconsistencies. But it would be presumptuous of us to sort of prevent any political interference, because after all, if there has to be a political interference, we are regulators, we cannot do much. Even central bankers can't do that. So, but the political interference, if that takes the form of drafting new legislation, we have to see the way it will develop, but I think it's the nature of things. Like it is today, right, by the way, when you have an industry that fails and it should be closed, I think we have a good example of a country in Europe about the car industry. No? We had a saga which lasted for a year. Where is Caio?
Caio just had to leave.
Caio left, okay.
He just left.
Okay, I mean, all the legislation, the bankruptcy legislation says that you shouldn't do anything. However, there was a political, let's call it political interference that decided otherwise. So, I think we have to take that. It's part of the functioning of democracies, I guess.
Ted.
So, Mario, I'd like you to maybe another direction from Anil's question about the shadow banking system. I was interested that you labeled that as a sort of uncharted water so far for the Financial Stability Board, and it would be interesting to see how you, and that strikes me again as, since even what different jurisdictions consider shadow and banking, if you may put it that way, are quite, I assume, are quite different. So I'd be interested to see I'd be interested to hear how you plan to sort of approach that issue, which is basically the perimeter issue, which we all, I think, recognize as one of the major causes of the problem, and many crises. I'd like to remind our Korean colleagues that they had the curb market was the same thing as the shadow banking system. It raises many of the same issues. So I'd be interested if you could expand on that aspect of your work program going forward.
Ted, this is it's obviously a very big area when we say the shadow banking system, and we'll have a lot of work to do in this area. But I think let me give you the three things I'm pretty, I would say, solid about. First, we have a mandate. All jurisdictions virtually want to do something about shadow financial service industry. Second, there is a common denominator about all of that, what all of them want to do, that is to increase transparency. I think we can move safely, first of all, to achieve this objective. And it's not, by the way, it's not an obvious thing to get. It's not an easy thing to get for a variety of reasons. Third, what is the likelihood that we are going to extend prudential regulation to non-banking sector, to the shadow banking sector? I think it's all in all, it's not high, because the shadow banking or the shadow financial service industry doesn't have access to the central bank lending. So in a sense, but I'm not ruling out anything really. But there is one fourth statement which actually describes more the complexity of the issue. More and more, monetary policy exerts its effects through the changes in the balance sheets of financial intermediaries, especially the non-regulated financial intermediaries. It's not true in all jurisdictions, it's true in some, in the largest, by the way. And one thing we have discovered, not so much as regulators, but as central bankers, is that how little we know about these changes and about how these balance sheets change when monetary policy changes. So there is a lot of knowledge that we have to acquire before we can actually design a regulation. But so far, even the objective of achieving greater transparency, greater visibility, is a fairly challenging one.
We have, I'm afraid, reached the end of our time for this session. We are going to continue discussing these issues at the next panel, and in fact, a bit of it even in the last panel on the financial architecture reform. So Mario, we thank you enormously for sharing with us your experience. I think I speak for most people here in saying how much we congratulate you on what you and your colleagues have achieved. It has been an enormous amount in a relatively short period of time on a crucial and very complicated set of issues. So we congratulate you, we wish you the best of success going forward, and we thank you for sharing your time with us today. Great to have seen you.